Welcome. I'm Catherine Magaña here with Rachel Ivanovich and Vince Stefano, where we're here to provide you insights on the markets, planning, and taxes. Today is Yom Kippur, so we want to wish you a meaningful Yom Kippur if you're celebrating that today. And the big headlines this week is the government shutdown, and we're seeing that everywhere. We'll make sure we touch on that today, but before we dig in on that, I just want to give you a weekly update of where we're at with some of the markets. So from last week to this week, we actually seen a pretty nice uptick in some of the different indexes. The Nasdaq is actually up over 1% this week. As of yesterday's close, as of October 1st, the Nasdaq is at 17.84%. The S&P 500 is at 14.10%, and the Russell 2000 is at 9.51. And the Russell 2000 didn't have too much movement over the last week. It's up about 0.33%. So that's one that didn't have too much movement over the last week. And then we are seeing indications for kind of the probability of a rate cut. It looks like as of now, the FedWatch tool is showing a 100% chance of a rate cut later this month. And there's chances of 2 rate cuts between now and the end of the year, and that's 86%. So we are potentially going to see a few more rate cuts. As I look at the interest rates and where we're at, the 1-year CDs haven't changed, so that's still at 3.75. But the U.S. Treasuries have come down a little bit. As of this morning, it's at 3.66% for the 1-year Treasury. And as we mentioned, that it's interesting. As we've been talking to clients recently. We do have a lot of clients that listen, and they realize that that cash that's sitting on the side, those rates have come down, and so we've been having some conversations about making sure we have the emergency money and some money set aside, but then also putting some money to work. So we're happy to continue those conversations with you. But I thought I'd touch on the government shutdown. So that's one of the things, obviously, that's top of mind right now. And I thought I'd share with you kind of how the government shutdown could affect your investments. So since 1980, there have been 10 U.S. government shutdowns. And the 3 shutdowns have lasted 3 to 5 days. And there's another 3 that lingered from 2 to 5 weeks. And so obviously when you think of shutdown, it can be scary and nerve-wracking, especially if you're a government employee and not knowing how long this is going to last.
That long one was in 2017, right?
I think, well, the last one I saw was the one in 2018, 2019 was...
3 weeks.
That was 35 days. Was... December 22nd, 2018 through January 25th of 2019.
We didn't start tax season until like February 12th. I know. It was crazy. I was like, what's happening this year?
And so kind of looking at that time frame, it looks like during that time period, the S&P 500 gained 11%. And the Nasdaq gained 14% during that time frame. So that was kind of interesting. The markets actually didn't go down. They went up. But then the GDP, so during the shutdown, when you look at the GDP, quarter 1, 2019, GDP fell at negative 5%, but then it bounced back at 2% in Q2 and 2.1% in Q3 of 2019. So obviously, we don't know how long this is going to last, and there are... I don't know. There are concerns. Is it get short or is it long? But the one thing that I think that comes top of mind for a lot of investors and clients are, am I still going to get my Social Security and Medicare? And so those are still things that are still in place, as well as TSA. They still are have those employees there, but you should obviously be prepared for maybe a little bit longer wait times.
And you still have to file your taxes by October 15th.
Oh, man.
I have had clients reach out and say, do I have to file this year still? And the answer is yes.
But the question is, can you call the IRS?
No, you can't get through.
You can't get through even when the government isn't shut down, so it doesn't matter.
That's why you need to set up an online account.
Yeah,
I'm telling you, those are great.
So, I mean, it seems like the markets haven't moved too much in the last few days. A little bit today, but the first couple of days it really hadn't done too much. So.
Well, I'm going to do a mea culpa on the last number of podcasts that we've done. I said September was going to be a very difficult month for the stock market.
What happened?
You did.
I was wrong. Now, there were a couple of days where we had to pay the stock market gods like we always do. But, overall, it was actually a very good month. And Catherine's numbers, gave proof to that. Also, a couple of points. Elon Musk now has a net worth of $500 billion.
Wow.
Sorry, Rachel, you're in second place. The stock market has hit new highs, despite this government shutdown. Mega cap stocks continue to run. And what's interesting is that a lot of people, as I've said before, the FOMO, fear of missing out, they're chasing performance. And what's kind of interesting is U.S. listed ETFs so far this year through the end of September have taken in $917 billion. Wow. Now they didn't break down what kind of ETFs were, but the majority of those ETFs were obviously stock funds because investors want returns. They're afraid that, they're going to get stuck in lower yielding investments that you were just talking about. And I've been saying that all along. Be very careful as these rates start to come down. You're going to start looking, not so good in some of these, shorter term yields. And so you want to move back into more of the kind of risk investments, and that's stocks, either ETFs or mutual funds. You had mentioned the shutdown, and what's kind of interesting is markets right now feel there won't be any meaningful economic impact from the government shutdown. And the reason is because they think if there's a slowdown, there's going to be an additional 2 rate cuts by year end. And you mentioned that as well. Yeah, you already talked about that. And again, we always say, the market focuses on interest rates, revenues of companies, and company earnings, free cash flow margins, and all the great fundamentals that surround a company. Government shutdown can be very, very temporary. It could be a couple of days. My guess is it's going to last about a week, maybe 10 days at the most, and it won't have that much impact on the economy. I think that when we kind of look further, what we're seeing is that with the stock market right now, about 45% of Americans have their household net worths are in stocks. Now, I don't know, what that total dollar amount is, but it's got to be in the many trillions, I would assume. If 45% of the American households have their net worth in stocks. I thought that was kind of interesting because more and more people are moving into the markets. And again, I think it's because people want performance. People are looking around and saying, where can I get the best performance? And it's always in the stock market. Now, granted, you have to have a time frame, but all in all, I think that, if you're going to, you want to play in the big casino, you want performance. So.
Well, we had a meeting this morning with a prospective client, and the spouse or the wife, she seems a little more conservative than her husband. He seems a little more willing to take a little more risk. But the comment she made was, if she also wants to learn. I think she says, if she learns and she's willing to be a little more moderate, but she, obviously it's
to make educated investment decisions. So I thought that was interesting.
Yeah, so I think that part of this is, sometimes when you are a little more conservative, occasionally it's because maybe you don't understand or don't feel comfortable. And so once you learn or feel, and it doesn't mean you put everything all at once. It could be a couple meetings or educating, but yes, historically, stocks do outperform bonds, but along the way, it's making sure you're informed, and that's kind of our job, is to educate. So that being said, I thought I would give you a little take on the Fear and Greed Index. I know Steve's not here this week, but we wanted to make sure we kept up with that. So right now we're at 50, so we're at neutral. So obviously we mentioned the markets are doing great, but I think obviously with the...
People are nervous.
Yeah, with the shutdown and still a little bit of uncertainty. But I think between now and the end of the year, we've had a pretty decent run-up with the markets and investing so far. So if we can just finish up, now that we're in the fourth quarter, hopefully we can finish up strong. So over the last week or so, we've had a few conversations, and we thought we'd kind of share a couple items that have come up with some of these clients, or prospective clients we're meeting with. And we recently met with a woman last week she's an amazing saver. She's been working at a big company for over 30 years, and she's been saving money in her retirement plan for since then, for many, many years. And she actually has inside of her 401k plan a concentrated position in her company's stock. And we are looking at that with her. One of the things that we're looking at with her is the net unrealized appreciation. And so I thought I'd let Rachel kind of explain a little bit about that. It's not, we don't see it all the time, but it is something that's out there. And I think we brought it up.
You've actually seen this. This is the second time this year that it's actually come up. So net unrealized appreciation, or NUA, what it does, it allows you to move employer stock from your 401k into a taxable brokerage account and pay ordinary income tax only on the cost basis of the stock. So when you think about your 401k, you're putting money in, and it's part of your salary, so salary deferral, so you're putting in pre-tax money, so that money hasn't been taxed yet. And typically when you take money out of the 401k, it is taxed as ordinary income. So this is a way where you can take a piece of that 401k, carve it out, pay tax on a piece of it, and then later you're going to be paying hopefully long-term capital gains taxes if you hold it for over a year. So basically, it allows you to move that employer stock from your 401k into a taxable brokerage account, and you pay ordinary income tax on the cost basis of the stock. The remaining appreciation, so let's say you paid, I don't know, $10 to buy the stock, and today it's worth $145. So the difference, which is $135, then later when you sell it, that'll be taxes at long-term capital gains rates instead of ordinary income tax rates, which typically can be quite a bit higher.
But if you continue to buy stock at even a higher price, doesn't that lift the cost basis? I mean, it doesn't. If you're managing a portfolio,
you'd have to manage it carefully.
I mean, what do? Do you have to say, oh, this is $10 stock, I'm going to take this $10 stock? Or every year that you buy more stock, does that lift your cost basis?
You would have to look at all of the different, so if you had this, for instance, that would be a different account, but in a 401k, you would have to take the cost basis of whatever the stock was when you purchased it. So maybe you had, maybe you had over 40 years of working at this company, you were buying the stock in your 401k, and so now it's highly appreciated. So there's a lot of math there, but that's why you work with professionals, Vince.
And then you have to look at the concentrated position and how you diversify. There's a little more to it. But
and the other piece of this is, in order to qualify for this, you have to have a qualifying event, meaning you have to retire and then you have to distribute your entire 401k balance in that year. So it gets a little bit tricky. You have to move it all over to an IRA.
So there's a little nuances, but we're happy if this is your situation, let us know.
It's just a very interesting way to look at your 401k if you do have a lot of company stock in your 401k.
So speaking of 401ks,
yes.
So
there we go.
The IRS came out with some final
last week we mentioned a little something about the Roth catch-up for 401ks starting in 2026. And of course, there's new regulation that just came out. It's hot off the press. So it says now beginning in 2027, the traditional catch-up is treated after tax rather than pre-tax. And so similar to what we talked about last week is for those that are 50 years and older and their income hasn't exceeded $145,000, then you can, going forward, your match is going to be, your catch-up will be in Roth and not pre-tax. However, the guidance says the rule is effective January 1st, 2027. However, some employers may already put this in place.
Typical of the IRS.
I know, and it says basically employers should work with their payroll providers and make sure systems are in place for 2026. So ideally, you have until 2027, but it looks like it may be rolled out.
You probably want to talk with your payroll department to find out what rules they're following. So they had the proposed guidance, and then now they have some final guidance, and they keep switching which year that these new rules are going to be in place. But you also need to plan accordingly for taxes, because if in the past you were over 50 and you were making your catch-up contribution to your 401k and it was salary deferred or it was deferred,
yep.
And now all of a sudden it's required to be after tax, that's another $7,500 that potentially you're paying tax on. Yep. And then if you're between ages, 62 to
63,
there's
the extra
the
catch-up.
super catch-up.
Yep.
So it's almost $11,000 more that all of a sudden you may be paying tax on. And if you're in higher brackets, and these rules apply to people over 50 who make over $145,000. So if you're under 50 and you don't make $145,000, you don't have to worry about it.
Yeah. But we thought we would share because last week we thought it was supposed to be 2026, but it looks like there's
Well, it was
a little
supposed
more.
to roll out, I think,
in 2024.
Exactly. And then they pushed it, and like I always say, it's never permanent until,
Government makes things so complicated, don't they? They just got to keep making things more and more complicated. I guess they justify their existence on Capitol Hill that
keeps
way.
the accountants in work. I don't know. But so I took some continuing education this week, and I'm committed to learning some fun loopholes for higher net worth individuals. And so one of the topics they talked about this week was called upstream gifting, which I'd never actually heard of before, but it makes a lot of sense. It's kind of interesting. So basically what this is, it's an estate planning strategy for high net worth individuals. And basically it involves gifting highly appreciated assets to an older relative. So for instance, to your parent, in order to minimize future capital gain taxes. So the way this works is it kind of hinges on that stepped up basis rule that if you buy an asset and if you leave it to beneficiary, when you pass away, the beneficiary gets the step up in basis, meaning the basis of that asset resets to whatever the fair market value is. So the way this upstream gifting works is you transfer an appreciated asset. So for instance, you own a stock or maybe it's real estate and you transfer it to an older relative, such as a parent or a grandparent. The parent receives the asset, and so now the parent owns this asset. And for the strategy to work, your parent's total estate shouldn't exceed the federal estate tax exemption limit. So let's just say your dad has an estate that's only $1 million. He's living on a pension and Social Security, so there's no danger that his estate's going to be over the $13 million or whatever the limit's going to
14.
be.
Yep.
Oh, it was 14.
I think it's
13.99.
Yes.
Yeah. So the parent then leaves the asset back to you in their will. And so through their will or trust, the parent leaves you the asset. And then when you get it back, you get the stepped up basis. So let's just say, I don't know, let's use a house for an example. So for instance, you own with your husband or your wife, you own a second property or, a rental property or something like that. And you purchased it for $400,000, but now it's worth $1 million and you want to sell it. But you'd have to pay capital gains tax on $600,000. So let's just say you gift the house to your dad and he's in great health and you have to file a gift tax return. You don't pay any taxes when you file a gift tax return. It just effectively reduces your overall gifting limit for your lifetime. And then, dad owns the house for another, 5 years, and then he passes away. He leaves the asset to you, and all of a sudden the house is worth 1.5 now. You originally bought it for 400, so you get to step up the basis to 1.5. You can turn around and sell it and pay no tax. Woohoo!
Yay.
That seems like a win to me.
Wow.
And then along the way, making sure the titling and all that of those beneficiaries or trust or just all that.
So the things you have to keep in mind are clearly trust, making sure your parent will leave you that asset. Changes in tax laws if they change the step up in basis rule. There is a 1-year survival rule.
What happens if your parents aren't alive? You can't do it.
You could do it to a relative.
Any relative?
You could do it to any other person. And they could, as long as they leave that asset to you in their will, you can gift anything to anybody. You just have to file a gift tax return. The same idea.
I want it back.
Yeah, I want it back.
Well, and so it comes down to trust. So think about it. And so there is a 1-year survival rule. So whoever you gift that asset to, you want to make sure that they're going to survive at least 1 year.
What happens if they die within that year?
Then it goes back to carryover basis,
That
and
doesn't matter. Okay.
it's win-win as long as you get it back.
Right.
But think about it, you could do this with stock too. So if you have highly appreciated stock, and let's say you bought it for, or you bought it for $1 million, now it's worth $5 million, you gift it, and guess what? When they pass away and they leave it to you, you get up that stepped up basis. So just kind of fun.
Yeah.
It's called upstream gifting. Very excited about it. I thought it was I'd never even heard of it, but it makes a lot of sense.
Well, there you go.
Another twist in the tax laws.
And then you still have a deadline for taxes coming up.
Yes, 13 days. Yeah, we only have 89 returns left. But there was one other thing that I thought was interesting that we should mention. And so, for instance, a lot of clients, because of the windfall elimination provision, which was passed back in January of this year, a lot of people who previously were not eligible for Social Security benefits because they were government workers, teachers, firefighters, police officers. They've received lump sums of Social Security benefits, and they now will have to pay tax on that money for 2025. So typically, you could amend a tax return and claim the benefits because it's paid retroactively oftentimes to 2024. A lot of people are getting benefits all the way back to the beginning of last year. There is what's called a lump sum election that you can make, and you can include that income on your 2025 tax return instead of amending 24. You can make a lump sum election, and you can use the income from the earlier year if your income was lower versus using a higher income if you had a higher income in 2025. So just make sure your tax advisor is aware of this lump sum election provision. I thought that was it's good.
Say another
Another
good
little
tip.
twist in
There
the
you go.
code.
And these are all the things you're seeing in the CE thing, huh?
I learned that yesterday.
Cow.
I know,
Wow,
so
isn't it
exciting.
amazing?
Yeah.
And the rules are always changing. They're adding new
They are.
things.
And
It
they'll
seems
change
like-
next year, and you'll get some new CE.
And up next, I'll talk about IRMA and strategies to reduce it, but that'll be next week.
There you go.
So stay tuned.
There we go. Stay tuned. Fourth
little
quarter
teaser.
earnings results should be coming out pretty soon. Or third quarter, I'm sorry. Third quarter results.
We're in the fourth quarter.
We're in the
Yes.
fourth quarter.
I was like,
Third
wait a
quarter
minute.
results.
Yeah.
Kinda
October 2nd.
Yeah, kind of eager to see what they're going to look like since everybody was talking about, the economic slowdown. But I really don't think it happened. People were thinking recession. There was no recession. I do think that companies are going to do quite well. And again, I think that you have to position your portfolio to take advantage of that. And again, know that this shutdown in the government will end.
Yeah.
And so there's no need to go and sell stocks in your portfolio out of fear that, you're going to, stock market is going to go down to zero. So don't do anything dumb. Call your advisor. Call your advisor if you have any, if you have any major questions, if you have fears about what's going to happen. That's what they're there to speak to you about. I'm actually looking to increase the holdings in my portfolio for the next 6 to 9 months because I do think that if the Fed continues to cut rates, stocks are going to do well, and I want to take advantage of that. I don't want to be left behind, so I'm looking to increase positions, not decrease.
And you're correct, Vince. There's always crisis or events or things that happen, and sometimes you think I need to do something, and the reality is it's just making sure what's your plan, is your plan working, or maybe you make some subtle changes. But once again, we are here to answer any questions or look at your current situation. And until next week, thank you for joining us this week.
Thank you.
Thank you.
Please stay tuned for important disclosures. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. WWM Financial is a registered investment advisor with the SEC.